Peter the Hitman Heckingbottom, Turn the Dutch Dynamo Dresmer, and Dave Boy Fishwick. Peter, why is it important for people to have information on equity investment?
I think investments in general are really important for everybody in the world today, because if you look particularly at the UK environment, there's £810 billion invested in investment markets, in defined contribution pension schemes. So everybody who's got a money purchase pension scheme has or should have a very great interest in the outlook for investments generally. And on top of that, there's about £1.3 trillion invested in investments generally. So the outlook for investments and the future of investments is vitally important to all those people. And it makes a real difference to the outlook and what people can expect in the future if they get those calls right.
And what is your view on equity investment?
I think what we look at particularly with equities is the starting valuation. So in other words, how much are equities worth at the time that you invest? And the typical measure that you use for that is called the price-earnings ratio. And that really measures the price of stocks in relation to the earnings that those stocks deliver. And it's measured in a sort of a multiple factor. So let's say the price is, say, 17 or 18 times the multiple of earnings. So that really reflects what the starting price is for equity markets. And there's a really strong correlation between the starting price and the expected return of those markets over the following 10 years. And there's some statistical evidence that shows the lower the price-earnings ratio at the start, the stronger the investment returns are going to be over that period of time, that 10-year period. And in 1974, for example, if you'd have invested in the stock market, you'd have probably been buying in when the price-earnings ratio was about 7. And you'd have got really strong investment returns over the next 10 years, something like 17% real per annum over the next 10 years. Whereas if you wound the clock forward to 1998, for example, if you'd have invested then, you'd have been investing when the price-earnings ratio is about 24. And the investment return that you'd have got from 1998 to 2008 would have only been very slightly less than inflation over that sort of time. So you really want to avoid investing when price-earnings ratios are high. So the automatic question is, what are price-earnings ratios now? And the answer is about 17 times. So on that basis, equity markets, we think, are fair value, and people should not be expecting fantastic returns over the next 10 years, but at the same time, not really rubbish returns.
Why is it
somewhere
important for
around
people to
market
have
average?
information on equity investment?